So chances are, if you have an investment portfolio, it's probably built on two main things, right? Stocks and bonds. But what if I told you that foundation might not be as solid as you've been led to believe? Today, we're going to look at a totally different way to build a portfolio, one that's way more resilient and goes way beyond the usual suspects. Okay, let's dive right in. First, we've got to talk about a pretty common trap that a lot of investors fall into. And most of the time, they don't even know it. So I'm going to ask you a question straight up. Is your portfolio actually riskier than you think? For decades, the advice was always the same. Just get a simple mix of stocks and bonds. We were all told, hey, it's diversified, it's safe. But turns out, that might not be the whole story anymore. This is what we're talking about, the classic 60-40 portfolio. You put 60% in stocks for that nice growth and 40% in bonds for safety. The whole idea was that they balanced each other out, right? When stocks zigged, bonds were supposed to zag. But here's the catch. In big market meltdowns, we've started to see them both go down together. This thing is called correlation, and it's when two things that are supposed to be different start moving in lockstep. It can be a real problem for a portfolio that's supposed to be safe. And you can see exactly what that looks like right here. When a major downturn hits, that supposedly balanced portfolio can take a huge hit. Why? Because both of its fillers started to wobble at the same time. This isn't just a theory, folks. This is a real vulnerability that we've seen play out. So, if that old model has a crack in it, what's the fix? Well, the answer might be adding a whole new ingredient to the recipe, something called alternative assets. And the definition is actually really, really simple. An alternative asset is, well, it's pretty much anything that isn't a stock, a bond, or cash in the bank. It's the everything else pile. And that's where things get super interesting if you're trying to build a truly diversified portfolio. You see, the real magic here isn't just what these assets are, it's all about how they act. Their secret weapon is a little something called non-correlation. And it really all boils down to this one simple, powerful idea. You want to own things that don't all go up and down at the exact same time. It's kind of like building a sports team, You wouldn't want a team with only quarterbacks, because when your star player, let's call them stocks, is having a really bad day, you need other players on the field who can step up and still put points on the board. So here's that traditional portfolio again. Just look at it. It's a two-trick pony, completely reliant on just stocks and bonds. It's kind of like trying to build a whole house using only wood and nails. Sure, it's strong, but it's super vulnerable to one specific threat, like a fire. But now, look at this. What a difference, right? By adding in just a few of these alternative assets, things like real estate or private companies or commodities, you've built a much stronger house. These new parts, they often march to the beat of their own drum. They can provide that crucial stability when the stock and bond markets are going haywire. Okay, so what in the world are these things? I know they might sound kind of exotic or complicated, but a lot of them are probably more familiar than you realize. Let's run through a couple of quick examples. First up, real estate. We're talking about actual physical buildings, apartments, offices, you name it. Their value is driven by things like rent and what's happening in the local neighborhood, stuff that has almost nothing to do with the day-to-day drama of the stock market. Next, you've got private equity. This is all about investing in companies before they go public on a stock exchange. Since they aren't being bought and sold every single second, their value is based on long-term growth, which helps insulate them from all that short-term market panic. Then there's infrastructure. Think about the physical stuff our world runs on. Toll roads, airports, power grids. These are essential things that generate steady, predictable cash flow, whether the broader economy is booming or busting. You can even find alternatives in tangible things, like fine art. Seriously, its value is driven by stuff like scarcity, the artist's reputation, and culture, things that are completely disconnected from corporate profit reports or what the central bank is doing. And finally, commodities. This is the raw stuff, like gold or oil. These things have their own cycles of supply and demand. And historically, something like gold often does really well when people are scared and selling stocks. It can act as a kind of safe haven when financial storms are brewing. All right, let's pull all of this together. The big takeaway here isn't to run out and buy a specific thing. It's about a new way to think, a new mindset for building a portfolio that's actually designed to weather storms and last for the long haul. So if you're going to remember just one number from all this, let it be 2. If your entire investment strategy is riding on just 2 asset classes that can and do fall at the same time, you might not be as diversified as you think you are. Real strength, real resilience often comes from looking beyond that number. Now, obviously, this isn't financial advice. It's more like a framework for how to think about this stuff. First, you've got to assess your own goals and how much risk you're comfortable with. Second, take some time to really understand the different options out there. And third, and this is a big one, you have to do your homework. Alternatives can be way more complex than just buying a stock. And that really brings us to the final thought. Once you understand the power of non-correlation, once you start exploring this world beyond just stocks and bonds, you really open up a whole new set of possibilities for your financial future. So we'll just leave you with this one question to chew on. What could your portfolio's future look like?